all of the mega cap names are in the red. And with the sector coming off its best year in more than a decade, the question is now the time for one of the market's hottest trades to take a bit of a breather? Let's ask venture capitalist Rashaun Williams of Antimatter Business Partners and Manhattan Venture Partners. Welcome back. Happy New Year. It's nice to see you.
It's great to see you. Glad to be here.
So we're looking at an ugly day, obviously, for mega cap, but it only adds to the narrative that this is just the way it might be for a little bit as we get a repositioning. How do you see that?
I keep hearing people use fear to try to convince the American investors to miss out on the biggest bull run of tech stocks that you'll see in the last 100 years. And I'm going to say the same thing this time that I've been saying every single time. If your portfolio isn't diversified with the S&P, but with an extra special dose of tech stocks, especially something like QQQ or just NASDAQ stocks in general, you're missing out. All the revenue growth for the last 10 years, tech stocks. The Magnificent Seven, tech stocks. When I grew up in the business, it was oil and gas companies, and then it was the banking industry. In this year and in this decade, your portfolio is all about tech stocks. So I'll even take the downside of daily, weekly, monthly volatility if I can get the upside of the annual returns and the revenue growth that I'm getting from my tech portfolio. So I love it. I'm excited about this year.
I don't think people would necessarily disagree with you, but they may quibble with the multiple that you're willing to pay for everything that you just said. And even though you're willing to pay a premium for it, are you willing to pay that big of a premium for it? How would you answer that?
7 years ago, when we launched our first late stage fund, every single person told us that tech valuations were bloated and too inflated. Now we have multiple tech companies that are valued at more than $1 trillion. So to me, it's not about the multiples per se. It's about how big these companies are and how dominant they are. All of these things are a relationship together. Multiples alone don't tell the full story. Dominance tells the story. When you have companies like Amazon, Apple, and Google, and Meta, like they deserve the type of multiples that they're getting. But also in my world, in the private world, where you have a company that starts from zero revenue and it does 20 million in revenue the first year, then 100 million in revenue the year after that, then 300 million in revenue, that's going to trade at a much more significant multiple than a company going from 1 to 2 to 3 million in revenue. So for us, we're looking for hyper growth and we're looking for dominance. And even though multiples are high, the only reason that VCs aren't getting the liquidity events that we need to get out of the market today is because multiples still haven't even rebounded from when they were 2 years ago, which is why most of these companies aren't even going public. So multiples are here to stay. And when multiples expand even further back to 2 years ago levels, that's when you'll see the IPO market pick back up for tech companies and VCs able to get those liquidity events that we're used to getting in a bull market.
I want to get to that, but work with me for a minute on Apple and the valuation there, because we're talking a lot about it today. It gets a rare downgrade, which you hardly ever see, especially when it's an underperform. Last year, the multiple on Apple, a year ago, it was 20 times, right? Mm-hmm. Now it's 28 times.
Yeah.
What has Apple done that justifies 20 times to 28 times when I could say, well, they just had 3 consecutive quarters of negative revenue growth and the smartphone market has been weak? So how do I justify that one specifically when I didn't even say the word AI?
Good question. It's something that's more important than smartphone sales numbers and tablet sales numbers. It's revenue, reoccurring revenue from services. That's the key to Apple's growth in the future. Look, they've made a killing off of innovation, but I think a lot of people are realizing that future growth and future margin increases are going to come from that service revenue that they're receiving from all of those little monthly $3.99s and $10.99s that you're getting hit from your account. So as Apple migrates and start increasing their revenue, which they have been at that same timeline that you're describing, to the reoccurring revenue that's coming from services, not just from product innovation, you'll see that those multiples increase because the market values that revenue higher than product sales.